Hello and welcome to a Lensgold Group mini webinar on improving marketing performance. Our approach at Lensgold Group is quite simple. We take you below the surface for deeper insights to help you develop smarter marketing so you can deliver more profitable performance. Here to present this session is Jim Lensgold, President and Founder of Lensgold Group.
Hi, I'm Jim Lensgold of the Lensgold Group. In this session, we'll take you through an overview of marketing mix modeling to cover the basics. This will help you understand how this kind of measurement can be used in your business. Then we have a part 2 session where we go more in depth into how to get more benefit and get more out of marketing mix modeling. Let's start with a quick introduction of who we are. Lensgold Group is a specialty consulting firm helping companies with measurements, analytics, ROI tools, and dashboards in order to improve marketing performance and profitability. As you can see, we've worked with many different global companies as well as emerging mid-sized companies in a broad range of industries. We're going to start off the session with just a definition, right? What is marketing mix modeling? So basically, it is taking marketing activity, all the non-marketing activities that can influence sales, and basically capturing that data, applying statistical modeling. We're talking about the real robust analytics in terms of regression modeling and time series analysis and other statistical techniques that are all combined together so that we could deliver an outcome as to how marketing has contributed to sales lift. Might help also to go a little bit further into why marketing mix modeling is needed. And this, in a sense, defines what we're trying to accomplish here. Right? So if you think about all the channels and tactics that you might be using for your business, everything from the online and direct media all the way down to new media and mass advertising. Right? So you've got all these activities. Within each of those categories of marketing channels, you've got tactics. So online advertising, for example, has placements in DoubleClick and Yahoo Finance and other specific areas. And when you look across time, what you see is that media plan shows many activities happening simultaneously, and it leaves a big question in terms of what's driving the sales outcomes. So the first reason we need marketing mix modeling is because overall this marketing environment is complex for measurements. Now, other reasons we might need marketing mix modeling. Think about some of our marketing activity which actually has a tracking element to it, right? That tracking might include responses, mentions, might include click-throughs or some form of engagement, or even leads. Well, we've got the tracking element there, but there's still gaps, right? When we look at our mass media, we may not have any direct tracking. And when we look at our tracking, and even if it goes all the way through to sales and revenue, are we attributing all that impact just back to one marketing channel and ignoring the others? Well, the reason we actually go to marketing mix modeling is that these simple measurements are not enough. Now, if we group all our channels and tactics together, we might say, all right, within those, we might add some dimensions of any offers or product introductions that were happening. If there's certain strategies or creative that were in place, we'll look to capture that information as well. We also want some non-marketing factors to be included in our analysis, right? It might include press and media coverage or pricing changes or some impact from our sales organizations. And then we want external factors, and those two big categories are competitive activity and market conditions, such as the economy and other market trends, because we're asking the question, out of all the sales increases and decreases that are happening, what's driving that? And there's a lot of different areas of influence. Right? So our third reason for needing marketing mix modeling is that we need to make sure we have enough information to guide decisions that improve our effectiveness. Right? So look at the big questions we have up on the board here. How do I change the mix to increase sales with my existing budget? Where am I overspending? Where am I underspending? Which marketing channels are effective but lack the efficiency to give me a good positive ROI? And I even want to know to what degree do these non-marketing factors influence sales? So how does it work? If we take marketing mix modeling, which is very complex and robust, but if we really try to simplify it and get the basic concepts, we start by looking at some data points. So here in this chart, we have total sales as the red line there, and we just have online impressions. And so visually, we could say, okay, there's a possibility that online impressions could be contributing to sales. We could look at other data points like radio, which has different peaks and valleys. Maybe a paid search that there's a trend it's on and it has ups and downs. So what the modeling is actually doing, then again, very simplified, is it's looking at these correlations between marketing points and sales It's factoring in lag time because media doesn't always have an immediate impact, and so there's calculations to figure out what that lag time should be. In some cases, we could test interaction effects, so perhaps online and TV works better than either one alone. It then works through, and again, mathematically, there's a lot of work to get this to how do all these components fit together, get the right drivers, and then we can attribute the quantity of sales from each of the different inputs, and in particular, our marketing variables. The models then work to find out what's most predictive, the combination of outcomes that we expect, and then we have to work also to maximize the significance so we have fairly predictive power so we can make decisions off. And so when we look at the outputs and some examples of what comes out of this, again, a simple version so we could just get a comparison here. If we look at the total sales over the period of time, we could break this down. So weekly or monthly sales lift. So out of all those sales, we could attribute some to print, radio, paid search, online, and television. We have base sales that are not attributed to any specific marketing, and that's because of the short-term nature. There is other long-term sales activity happening. Now, what we don't see in the chart is we'd probably have more marketing channels than this, depending on what our inputs were. We may be able to take some of these marketing channels and actually get a contribution down to the tactic level. So maybe certain print publications were drivers and others were not. In some cases, if the detailed data is there, we could look at campaign level impact. And then what's not shown on this chart is the non-marketing impact that we would quantify as well. Other ways to look at the outcomes. So you can see here that we've got the sales volume, and we started with our base sales and worked our way both up and down to reach the total sales, right? So each of the contributors, our marketing impact is a plus on top of sales. And then we've got the economy and some competitive activity that actually is showing a decline. So had we not done marketing, sales would have declined by a certain amount, and our marketing more than made up for that. Now, we also want to look at an ROI assessment, right? So the model shows our sales impact. We just quantified that. We have to apply an average profit per sale that we get our total return. We're going to compare that to our marketing cost. So our ROI formula is to figure out that net profit divided by the investment. And we're going to look at this from a marketing channel perspective. Okay, so a couple of highlights we have here, right? We have the budget for each of our marketing channels. We have our sales. We're applying this $285 per sale to get the incremental margin. And we're basically saying the return above and beyond the budget is what's going to give us an ROI. And the results are important, right? Because some channels, paid search and online, they're not generating as many sales, but they're generating a good ROI because the cost is lower. We'll make some decisions on print, on improving radio. Television, we may say, look, this is the short-term contribution. We expect other measures to help us identify the long-term contribution. Let's wrap up with a view into the marketing mix modeling strengths and limitations. So on the strength side, we get to measure a complete set of marketing tactics and not just one specific area. We get the impact of non-marketing factors, which we really can't get through other measures. We're working with high statistical reliability, so a lot of confidence in our measures. We get information that helps us guide changes in the marketing mix, helps us guide changes in the marketing spend, and ultimately lets us work our way to optimize that budget allocation. Now, on the limitation side, these are important. This tends to be more tactical than strategic. So we're getting measures at the tactics, but there's a lot more strategic questions that will go into our effectiveness. We're looking at short-term impact only, so we're not really getting that long-term impact, which requires other measurements. We're dependent on variance over time. So in any one of those marketing channels or marketing tactics, we need peaks and valleys in order for the model to capture the impact. So if it's consistent and running throughout the year, it's going to be very hard to detect. The model averages the effectiveness over the whole entire time period, right? So if we have changes in effectiveness in any one marketing channel or tactic, there are some other techniques that can be applied, but for the most part, the model it requires lots of data points, and it's going to use that average. And we get all this rich information as to what's working, what's not, but we don't get any of the diagnostics as to what to do differently to improve those marketing channels. So it's really just about budget allocation. And it is hard to refresh frequently. And the models are built on many data points. And so when you get one additional week or one additional month's worth of data, that's a handful of data points, and it's not enough to draw conclusions conclusively. And finally, the critical success factors. Use a strategic approach to your measurements, right? So not just the tactics, you need to understand how to drive customer behavior and outcomes. Make sure you disclose gaps and limitations of the model. If there's data points that are not good and it could distort results, it's better to disclose that. Make sure you add diagnostic measures to complement the model. Make sure the model is integrated as part of a robust measurement plan. Take steps to make your marketing more measurable. There's a lot of good techniques and opportunities here. And then take the conclusions we get from the marketing mix model and build those into ROI simulation tools so that we could do what-if scenarios. So all of those have more information that could go with it, and that's why we've set up part 2 of the webinar to cover those in more detail. So I'm going to thank you. We've set up a web page here, www.lensgold.com/MMM, where you get a copy of the deck and some other information on marketing mix modeling. Thank you very much.